Welcome to episode 174 of Wealth Talk. My name is Christian Rodwell, the Membership Director for WealthBuilders, and I'm joined today by our founder, Mr. Kevin Whelan. Hello, Kevin.
Hi, Chris. Good to be with you again.
Yes, and we've got a great episode today. We have best-selling author of the finance book, How to Own the World, Mr. Andrew Craig. And this is not a new book. It's been riding the charts for several years now, over 1,500 5- and 4-star reviews. So many amazing comments, and Andrew is a man with much to share, and we'll hear from him today.
Yeah, I mean, it's great to hear seasoned authors passionate about their subject, eloquent in the way they can disseminate that and break it down into bite-sized pieces. It's the art of a great teacher when you can do that, and Andrew does his absolute best to demonstrate some of those lessons for you, our listeners. And I think given the value and how much he has to share, Chris, we need to get out of the way and let him just share it.
Yeah, absolutely. Before we do that, I'm just going to let our listeners know that we've got one more Academy webinar coming up in 2022, and that's Wednesday, the 23rd of November. So if you are looking for a community, support, and really a structured process to help you build wealth, to move from a place of financial insecurity to financial independence, then please do join us on Wednesday, 23rd. Kevin and I will be live on that webinar. We're going to be walking you through our 9-step recurring revenue roadmap and hearing from some of our members and showing you how we can help you to put that plan in place for 2023.
Mm-hmm.
Cool. Okay, so let's head on over to our conversation today with Mr. Andrew Craig. Andrew, welcome to Wealth Talk today. How are you?
Very well. I'm all right, thanks, Christian. Apart from the broken foot that I told you about when we were just having a discussion, but no, really good, thanks, and delighted to be on the podcast.
No, it's great to have you here, Andrew, and our listeners have been looking forward to this very much. And your book, How to Own the World, has been around some time, and I think I was a bit late to the party. I didn't realize until actually not too long ago about this fantastic book. And really,
Christian, you're probably quite lucky because the third edition is quite a lot better than the first edition. Let's be clear.
That's right. Well, it'd be interesting to hear kind of the potted history in a moment, but I think your message really is all about simple investing, right? And by managing your own money, you'll be able to achieve higher returns and save thousands of pounds in fees and charges, and really helping anyone with this, right? Even if you've got a small amount, like £50 a month, is just how to learn how to invest better. So I'll ask you, Andrew, if you could sum up the principles of the book in just a few sentences, how would you do so?
Oh, that's a tough call. Well, I mean, I think that one of the first things is that investing is for everyone. Absolutely everyone. And it's important to distinguish investing from trading. And I think one of the big problems we have these days is that people go straight past investing into trading, particularly younger people, and they conflate the two. They don't realize the difference. So the message is really that focus on investing. Everyone should focus on investing. And it's a tragedy for our society that, an insufficient number of people invest. And what do I mean by investing? Well, investing just means doing something sensible. And actually, there's a huge range of things you can do. But if you do something sensible from the minute that you can free up a little bit of capital, maybe in your late 20s or early 30s, ideally, and if you invest in something sensible every month by direct debit from that kind of age, from your late 20s or 30s, for the whole of your life, the sort of, there's tons of academic empirical evidence to credit this statement, but you have a very, very good chance of becoming quite significantly wealthy. And so, that, if you like, is the big picture top down. Isn't it a shame that financial literacy is really poor and hardly anybody actually does that? A vanishingly small percentage of our society does that. The Americans are a little bit better at it than we are, but to be honest, even in America, probably not enough people are properly investing and properly learning these skills. And then, if you like, the second big picture thing, which is why it's called How to Own the World, is, investing is notionally scary. The reason that people destroy their wealth every year by being in cash ISAs, which, at the moment are underperforming inflation by many percent, which guarantees the destruction of your wealth, is because they're scared of the stock market. And a big part of what we teach is you don't need to be scared of the stock market or investing. There are a couple of lenses to look through. What one is, and why it's called How to Own the World, is if you see investing as a holistic, basically all assets in all major geographies, that you have a geographical and an asset hedge. So in a year like 07, 08, 09, where the stock market halves, Gold's up 20%. It was up 19.5% in 2009 in dollar terms. You know, oil hit an all-time high in the middle of 2008 when everything else was plummeting. And it's, you know, the Rothschild family, Harvard and Yale universities, Oxford and Cambridge universities, all the sort of smartest, wealthiest people in history have invested in this own the world way. And the other corollary to that is, if you do that, if you basically set up something sensible to capture all major asset classes in the, and when I say all major geographies, you don't have to finesse it any more than basically the US, Europe, and Asia. And if you do that, you know, and what are all major asset classes? Well, basically shares, property, bonds. Well, bonds is a bit of a sticky one, but interest rates, cash. Let's call it cash. Commodities, and you know, the other core asset classes. And if you do that, particularly if you do it regularly every month, so from the first time you can invest until the time that suddenly you wake up and go, goodness me, I've got a huge pot of capital I could potentially live on now. You know, that is a very kind of sleep at night way of approaching your finances. And the tragedy is that so few people are doing that. I mean, for what, you know, one of our biggest battles is that is human nature is, you know, fear of missing out. I mean, the stock market is the only thing, or financial assets are the only thing in people's lives where they want to buy more when the price is high and less when the price is low, like psychologically. And we all know about that because, like, oh, everyone else is, my mates made loads of money in crypto, or, you know, or, you know, there's been a massive crash, the stock market, that's for idiots, I'll never do that again. And of course, that's psychologically the opposite of what you should be doing. And if you like, the antidote to the way to sort of immunize yourself against that thought process is just to learn enough to be confident about the long-term outcomes of multi-asset, multi-regional investment. Be very confident, do it every month with a certain percentage of your income, and in the longer term with your wealth. And, you know, the smoothed effect of that over 20, 30, 40 years, there's a great book called The Millionaire Next Door, which is, I'm sure many of your audience have read. And it makes the point that, you know, the very significant majority of millionaires are normal people who do this. And actually, the flip side of that is 70% of lottery winners are bankrupt within 5 years of winning the lottery. And there are 150 Premiership footballers who are bankrupt, having, you know, earned ridiculous amounts of money. And any number, you know, Boris Becker's just gone to prison for being bankrupt and lying to the tax authorities. I mean, wealth, long-run wealth generation doesn't require massive income. And there are lots of bankrupt celebs who had massive income but never learned this stuff. And there are lots of people from every stripe of, you know, every walk of life who are millionaires by the time, you know, even if you start in your late 20s, you can be a millionaire in your 40s, even with relatively conservative assumptions. And I always say it's ideally a 30 or 40 year journey. Anyway, sorry, that's a bit of a long rambling answer as ever, but that's broad. It's own the world, all assets, all geographies, do it every month. And the final thing I will say to continue my long rambling answer is, it's really important to ignore the news. The biggest rookie error in investing, not trading, is, oh, you know, Liz Truss has been sacked, and, you know, the investing returns are negatively correlated to paying attention to the news. If you understand the sweep of 200 years of the development equity markets and, you know, decades of human progress is the most important investing theme in history, and that's driven 9% returns in US equity since 1872. Notwithstanding what's happened this year, or what happened in 99, 2000, or what happened in 07, 08, 09, and if there are 20, 30, or 40 year investment horizon of your life, you just ignore the news and genuinely do the blah, 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 and you set something sensible up, you will make far higher returns than most people who are either not investing and they're in cash ISAs, which is a disaster, or they're investing and then freaking out because, oh, there's going to be a recession, I need to sell. You know, that's the worst possible approach to investing. The best possible approach is just something sensible every month from your 20s or whenever you can afford to do that for 20, 30, 40 years, and you will be a millionaire. I mean, that's, you know, that's the mathematics are just really intractable, and empirically, even on an average wage, investing about 10% of what you save each month into the market and doing it sensibly over many years, you will be a millionaire, or certainly you'll end up with a high six-figure pot at the very least. Sorry, yeah, I hope that. So there you go. I've eaten up the first however many minutes.
No, that's fantastic. I mean, just what you're saying there about the 10%, you know, reminds me of The Richest Man in Babylon, right? Very small, simple book, which just is, you know, fundamentals which still apply today.
Yeah, absolutely. I love that. That book's written in quite, well, the version I had was written in quite amusing sort of Victorian language, for, you know, but yeah, exactly. Those, I mean, That one suggests it's a third, isn't it? You spend a third, live on a third, and save a third, which I appreciate in this day and age seems pretty challenging. But, you know, that having been said, if you start with 10% in your 20s and gradually inch up, if you have a decent career and you are quite successful, and you don't, you know, fill your fridge with champagne and spend 50 grand a year on holidays, or, you know, on credit cards, which seemingly lots of people do, if you are able to live within your means and be careful, even in the cost of living sort of situation like today, certainly by the time you're in your 40s or 50s and you've had a decent career, you can have higher saving rates than 10%. I think most people can if they really try.
Yeah, and that's the point. Obviously, you mentioned in the book is about this term financial surplus, and you know, you have to kind of design your life, don't you, to be able to put some aside. Well,
and it's, you know, the trouble is you start getting into very political territory here, where everyone's like, oh, you know, you're a right-wing libertarian and, you know, whatever else. But one of the examples I always use is, you know, the sort of famous Buddhist monk in their orange robe with a wooden bowl of rice has nothing economically, literally nothing, right? And yet you'd like to think most Buddhist monks, you know, the Dalai Lama, are quite content with their life. So it's a sort of slightly weird, obtuse thing to say, but I think if you calibrate your life out of the gate from, you know, when you're a teenager in your 20s, or you just calibrate your life in a way that gives you a little bit of surplus, and that surplus can increase over time. And look, it's really hard when you're a student and you've got student debt and everything else, but, you know, life is a marathon, not a sprint. And I think, you know, even if you find yourself in that position in your late 20s, just a small 25 quid a month for your 20s, and then bumping it to 50 quid a month, 100 quid a month as you get older and older. And if you have any kind of career success and you have that mindset, then you can get much bigger numbers by the time you're in your kind of late 30s and 40s. And if you do that for many, many years, all of those 25 quid a month that you did when you were 25, 26, 27, working in a bar or whatever, will be, you know, with the power of compounding, will be worth actually quite a lot by the time you're 35, and will then be compounding still. And that, you know, that the power of compounding is another key point in the book, which I know your audience is very familiar with.
Yeah, and we've obviously emphasised the point. Well, you have there, Andrew, about, you know, time is the key here. What about someone listening now who's already in their 40s or 50s or 60s and feel like I've missed the boat here? What would be your advice for them?
Yeah, I mean, in 40s, I think it's fine, you know, but I think decisions need to. One of the things we say in our book, my book, which is quite controversial, is, you know, one of the options if you find yourself not being able to save and invest is to move house. I mean, in all seriousness, like, it goes to the point of calibrating your life so that you can find some surplus for equity investing. Because if all you have is cash and property, you're fundamentally imbalanced, and your overall through your life returns are not as high, not likely not to be as high as they could have been. So that's pretty radical. But I think anybody in their 40s is all right. You know, again, this sounds, if you find yourself in a really tricky situation in your 60s, and you've just, you know, as sadly, because we're so bad at financial education in this country, far too many people have done. And then that's the other thing to say is, you know, the state pension system was set up in 1909 for anybody over the age of 70, when life expectancy was 47. So there were almost no people claiming a pension and millions of people paying into the system. And now that's obviously flipped on its head, and the demographics mean that the government, no matter whether you're left wing or right wing or Labour or Tory or whatever, it's just irrefutable maths. The only, you know, why do we have such high inflation rates today? Because the government's printing money that it doesn't have to pay out all its liabilities, that that nobody has the electoral strength or bravery to say that we just can't do this anymore. The system doesn't work the way it did when it was set up in 1909, and, you know, through the 40s, 50s, 60s. You know, it's much easier, rather than standing up saying, look, this whole system doesn't work. It's easier to just go, we're implementing a program of £100 billion worth of QE in order to, you know, because, like John Maynard Keynes says, not one man in a million understands inflation, right? And that is what's coming back to bite us right now. I mean, I personally think that hope is not lost, because and we'll maybe come on to this, but, you know, real economic equity value creation happens from technological innovation and human progress, and I think that could ultimately kind of save us and create enough wealth so that not everyone's living on cat food for 40 years. But you know, we are in a period of dislocation now. People are really experiencing that. But if you are in your 60s and you've really never been able to build a pot, and you're looking at the state pension and thinking, God, what a horrendous life. this may sound like a sort of naive young man thing to say, but one of the most uplifting ideas, I think, in the modern age is there's a guy called Kevin Kelly who founded Wired magazine, the #1 tech magazine in the world. And he wrote an article in 2008 called 1,000 True Fans. And I would exhort anybody to read that article who's kind of finds himself in financial dire straits generally, because it says that unlike any other time in history, the internet gives us the opportunity to access a long tail of well, in the old days, basically, whether it's record companies or lawyers or whatever, there were gatekeepers that owned the market, and 99% of the money went to the top 1% of companies. And if you weren't IBM or Tower Records, or I'm clutching brands out of thin air, but now, like never before, if you have 1,000 people willing to pay you $5 a month for something through the internet, a newsletter, a podcast, or whatever, that's £5,000 a month. If they're willing to pay you £20 a month, everybody can do the maths. And rather than thinking about going and working for an employer that might pay you 40 grand or 30 grand or whatever it might be, if you get to a certain age and stage and you have skills and you have knowledge and you're relatively dynamic, I know that one of your 7 pillars is business, right? And I just think that it's actually, notwithstanding the constant woe that we have in the press about how dreadful everything is in Ukraine and Liz Truss and what, it's never ever in history been easier or cheaper to set up some kind of online business that might actually help you financially. And so that, you need to read books, you need to figure out how to do things, you need to write a business plan. I mean, that's the other empowering thing is there's an awful lot of money out there in the world, and people with money have never been more challenged with interest rates as low as they are, right? And inflation as high as it is, to find real returns on their money. And I always say, we have an entrepreneurs group where we always talk about the fact that the fastest route from A, which is not being very happy with your life and being in trouble financially, to B, which is the reverse of those two things, is to learn how to write a business plan. Because if you write a business plan that can pay you a wage, and you take it and it's compelling enough to telegraph to some angel investors or some high net worth individuals that they will make a return that's above inflation, then you can literally, one business plan can change your life. And sorry, I've probably gone slightly off piece there, but I know business is one of your pillars, but we genuinely believe that. We think that, maybe it's not for everyone, but it's an option.
No. Agree. And IP, right? We've all got IP, we've all got that experience, knowledge, and as you say, if you can package that up into something that's valuable, then there's an opportunity.
Although I can highly recommend not relying on finance books, because even though How to Own the World is one of the best-selling finance books in the UK, I almost burst into tears when I see that that my publisher's like, congratulations, you're at wherever you are in the league table of finance authors this month. And then my eye goes across the page of the Nielsen unit numbers, and I look at Nigella Lawson and Jamie Oliver and think, I really should be writing about food. But I mean, that in itself is so indicative and depressing, right? Like, British people will spend untold millions on books about food and like pasta and whatever Nigella Lawson's latest cake is. And they won't spend any money on thinking about their finances. And like, ultimately, I mean, I like food as much as the next person, but ultimately, learning about finance is so much more life affirming and so much better for your long-term life experience than being a good cook.
Yeah.
It just my view. And literally we sell like 1,000th of the number of copies that they sell, right? Finance authors and food authors. Not all. Well, anyway, sorry, another red herring.
That's okay, and there's just so much that I want to speak to you about. So we've got lots to cover. But it's interesting there. You mentioned your publisher. Obviously, they take their cut, and you mentioned the music industry, and that was my background. I worked at EMI and was in music industry for 16 years. So I've seen how that has changed massively, and the independence, the independence that artists have now with that. But let's talk about fees in the financial world, because fees really are the sort of silent killer, one of the silent killers, right? So, what are your thoughts on this, Andrew?
Well, it is actually quite a nuanced subject, because, like anything else in life, if you pay peanuts, you get monkeys, right? And so whilst in my book, I have been very clear that if you acquire enough knowledge and you have enough confidence, and particularly if you start early enough, you start young on your investing journey, you don't need to have a financial advisor, and you can do some very, very simple stuff. You know, basically buy the market every month, buy direct debit with an investment platform like Interactive Investor or AJ Bell or Hargreaves Lansdowne or whoever else it might be, or Vanguard. And if you do that on autopilot for years and years and years, you will accrue loads of, you know, a really, really good amount of capital. If you are doing it every month, you're putting your fingers in your ears, you're ignoring the news and all the people in the pub telling you there's going to be a recession. You know, there's almost no correlation between financial market performance and real economy performance, by the way. Recession, there's always a massive lag. It's completely uncertain. It's one of the great fallacies that there's going to be a recession, therefore the stock market will crash. That's basically, there's a very, very scant relationship between those two things, which is another sort of rookie mistake people make. But in terms, so that's one option. That having been said, though, there's some well-known research that says the average person with a financial advisor retires with about £40,000 more than the average person without a financial advisor. Now, that is a figure which you should be quite suspicious of, because just the tyranny of statistics, right? Statistics can show anything. I mean, because obviously, correlation and causation, right? If you are the sort of person who goes and looks for a financial advisor, you are likely to be a wealthier person who's more interested in financial advice than somebody who doesn't even know what a financial advisor is. So that obviously skews the numbers. But I mean, my basic position on that is, you know, dare I say, if you read my first book, How to Own the World, and you're young and you've got lots of time on your hands, you should be able to implement a perfectly sensible investing strategy which saves you a lot of money on fees, because you don't need a financial advisor when you're 25 or 30 or 35 probably. But the older you get, you know, if you have managed to build up to 3, 4, 5, 600,000 pounds by the time you're in your sort of late 40s or early 50s, let's say, and if you have children, particularly, there are inheritance tax considerations, and now you've got property, and you know, your affairs are much more complicated. I think at that point, it's probably very good. It's probably sensible to use financial advice, and the fees are probably worth it. But you have to be very careful. I mean, the key thing is to understand what you're paying and what you're getting for what you pay, and the difference between a financial planner and a financial advisor. But you know, you can do 30 years of just having a sensible thing in place and building your pot. But when you get close to retirement, that, you know, financial advice is probably worth it from good financial advisors, because they'll save you. You know, in that example, they'll save you significant amounts of inheritance tax by optimizing inheritance tax planning.
Yeah.
Just that alone is probably worth a few grand, right?
Yeah. Now, we've touched on pensions, you know, a little bit already. I've heard you refer to this black cloud pension crisis ahead, Andrew, and a question you get asked about, you know, should you put money in your ISA? Should you put it in the pension? Any words on this?
Well, look, I mean, I often say that big picture as a society, and I'm talking about like global societies, certain Western developed capitalistic societies, we're in a race between Mad Max and Star Trek, as in, you know, that things are so bad in terms of how badly run, you know, the West has been, Britain, America, you know, Western Europe, for many, many years. It's not so bad in certain parts of Asia, but well, although Japan's a bit of a balance sheet disaster, national balance sheet disaster, but you know, we literally could have hundreds of millions of people confronting a retirement of utter poverty because the government can't afford to fund them and they haven't legislated for it themselves. So that's the kind of Mad Max, you know, post a dystopian future of like war over resources, and that, you know, frankly, that's the sense we all get when we contemplate Ukraine and the cost of living crisis and the environment and all that. But actually, my genuine belief is that, as always for the last several centuries, it's human progress that rides in on the white horse to rescue us, right? Because it's human progress that solves all those intractable problems like the environment. And you know, Ukraine's a bit of a different situation because those security matters are always, you know, something different. There's not much to do with economics. I mean, it impacts us economically. But you know, if we have enough companies doing enough wonderful things and solving enough of our problems, like environmental degradation or clean power generation, et cetera, enough, in the same way that Apple, IBM, Microsoft, you know, et al., Google have created trillions of dollars of real wealth, and, you know, high-speed trains and new buildings, and there's trillions of dollars of real wealth in the last few decades has made the life a lot better for a lot of people in the world, if not in Western Europe and America. If we carry on that trajectory, and ultimately technology can save us and technology can sort out that pensions crisis, because everybody's pensions in equities, and if equities create trillions of dollars in new wealth, that will save us. I think that's probably a few decades away, or at least one or two. And so in the meantime, yeah, we have a pretty bad challenge. But to your question about the difference between ISAs and pensions, I mean, ultimately, you know, I think a lot of people in the general population think the pension is some sort of monolithic thing. You're either in a pension or out of a pension. I mean, a pension is just a tax-wrapped account with which you can do any number of things. And so, you know, for most people, the judicious use of pension and ISA to shelter tax in different ways is the optimal thing to do, as long as what you're actually investing in the pension and the ISA is also sensible. And you know, so we teach people to be mindful of the right mix. And you know, will the UK government start? So Argentina in 2008 nationalised all pensions. So any private individual in Argentina who'd been saving all their life in a pension, goodbye. Their money was gone to the state. Could Britain do that? I don't know. I mean, maybe a future government will do that if things really go the wrong way. But which is why I think if you're young, you know, in some ways, ISAs might be a good place to start if you think about filling the pot. ISAs first, and then, but then again, if you have an occupational pension with a generous employer who matches your contributions plus the tax break, you know, but the key thing is just knowledge. If you understand what a pension is and what an ISA is, and your own personal circumstances, then you can optimize the two, and most importantly, put the right investments in both of them. Because, you know, having a pension is not much use to you if you're making 2% a year in an inflationary environment of 10% a year. But having a pension and having a clue and actually knowing what you've invested in over 40 years can make a massive difference to your life, right?
Yeah. Now
another very long answer. Sorry, go on.
I'm enjoying it very much. You've alluded to the future. I'm going to come on to that in a moment, Andrew, because I know that that's a topic very close to your heart, and also the second book that is kind of almost complete. So I'm really looking forward to hearing about that in a moment. But there's two more kind of assets I just want to talk about with you before we do that. One of them is property, because many of our members, and we know everyone in the UK, right, has this love affair with property. But property has been a great asset class and has helped many people reach financial security, financial independence. But you've got some quite, I'll say, strong views on property, and also an interesting formula, which, you know, really is quite a simple formula that you believe most people, you know, not really aware of when it comes to evaluating whether property is cheap or expensive. So would you mind sharing that for us?
Yeah, well, I think the thing about property is I often get people pillory me for being like a massive property bear, which is just not true at all. The only point I want to make about property is, like any other asset class, you should just know, you should understand the basic metrics with which to interrogate whether something is expensive or cheap. And also, one of the most fallacious things about property is, particularly in the UK, is people don't think about property in real terms. They think about property in nominal terms. And so just to explain what I mean by that is, if you sit there and say, I bought a house for £1 million 10 years ago, and now it's worth 2 million quid or whatever, how much has the value of the pound depreciated by in that time, both because of inflation and on global currency markets, right? So a £1 million house, let's just keep the maths easy and say you live in a part of the UK where a £1 million house 15 years ago is still a £1 million house, because it's not like Notting Hill in London or, you know, hot bits of Leeds or Aberdeen, or, you know, you're just in a place in the UK where property market, and there are places in the UK where this is true, right, where property has basically almost gone sideways. And so you bought a £1 million house 15 years ago, and it's a £1 million house today. Okay, well, 15 years ago, that £1 million house was a $2 million house. Okay, because it was $2 to the pound. Your house was a $2 million asset in global purchasing power parity markets. Like 80% of the world's stuff is traded in dollars. Like most of the stuff we buy, wheat, cotton, you know, copper, oil, everything, right? So people go, oh, well, it's not relevant. Well, it is absolutely relevant to your life. It's why we're going through a cost of living crisis right now. Part of the reason for that is because sterling is in such a perilous place, right? So, okay, so it was $1 million house. It was a $2 million house 15 years ago. What's the cross rate dollar pound today? 112? I don't know. But let's just say it's a $1.1 million house. In dollar terms, in the currency in which 80% of stuff is traded, you have lost $900,000. So everyone goes, oh, I bought a property for £1 million, it's still worth £1 million. You're down $900,000 in terms of purchasing power of that asset for stuff that matters. which is why when you go to the supermarket at the moment, everything seems so egregiously expensive. It's like, what's going on? So very few people think along those lines, and you need to think about along those lines if you want to be properly sophisticated about how you think about an asset class. Now, then the second thing, of course, is inflation. Because if inflation's 10% and your property's £1 million, it needs to be 1.1 million quid next year to stand still. And most people, when they contemplate the development of their property, the property prices are not sufficiently accounting for real inflation. So it's like, okay, great, you bought a house in London in 1975 for 100 grand, and now it's £1 million. But then in 1975, the average salary was 10 grand, in London. I mean, and a car was like £300, and a pint was 10p, and a Mars bar was 1p, or whatever it was. But people, and I obviously unpack all of that in detail in the book. So when you think of property, of course, in many parts of the UK, particularly, property has significantly outperformed real inflation to date. It's been a great asset class in many parts of the country, but that's had a lot more to do with interest rate markets, with mortgages and with the decline in interest rates over the last 20 years than anything else. And obviously that's now going into reverse potentially. I mean, we just saw it yesterday, interest. I mean, that is, if you're contemplating property and you're not thinking about so the long run average of US 10-year for the last 50 years is 6%. And it's been as high as 13 or 14%, right? So if the average of interest rates is 6%, we're still half where average interest rates could be, and what does that mean for British property prices? Well, it's pretty scary, to be honest. But so my basic position on property is just when you go into property, be very careful that you model the cost of money potentially being very different in the future what it is today, which is happening right now. Account for the value. Think of your property in dollar terms, probably is the easiest, or at least in gold terms, as spurious as that sounds. If you actually look at the price of gold versus the price of property, it probably tells you a great deal more about what the real value of British property is than looking at it in terms of pounds. So certainly in terms of pounds. And so, if you do that and it still looks good, then go for your life. Because of course, the other thing about property is it's one of the very few assets where you can borrow money. So you get that gearing effect, which you can't get in a lot of other areas of investment. But, gearing's great if it's going in the right direction, but it's really bad if it's going in the wrong direction, as lots of people discovered in the early 90s and, many times before in history. So, sorry, that again, the basic point is just make sure you're conversant with all these ideas before you, a tragic thing that you see so much of is working, both husband and wife in a couple working really hard, nanny looking after the kids, dawn till dusk, really, really tough jobs. And between both of them, they're spending more than 50% of their post-tax salaries across the two of them to live in a house at these interest rates. I mean, that's just asking for trouble, right? And I just think it's tragic that we are so obsessed with property in the UK that people are willing to maybe not be as ambitious about their house that they live in, and because I only say that because our motivation is, we want to improve the financial affairs of as many people as possible. And the reason for that is because the second order benefit of sorting your finances out is you're much happier. It's nothing less than that. So why make yourself potentially miserable by just sort of risking things at low interest rates? And anyway, yeah, sorry, again, I didn't want to get but I'm not just an unrequited bearer of property. I just think it's really important to think about real versus nominal, inflation, cross rates, and what might happen to interest rates.
Yeah, no, it's interesting. And I think one of the things that attracts people to property and is definitely a great thing is the recurring income, and that regular, predictable recurring income on a monthly basis from rentals. How do you compare that with the markets in terms of being able to actually create cash flow that you can spend and live your life on a regular basis?
Well, yeah, but that's great if you've got your model right and your rental income is through the cycle it more than the cost of money and all the other costs attendant, like void periods and new boilers and everything else, right? And in a rising market, everything looks rosy with interest rates at 2% or whatever, but they look very different with interest rates at 6%. And when also the economy is really challenged and you can't find tenants as quickly as you used to in the past because everyone's unemployed, right? I mean, and as long as you've built enough resilience into your model to cater to those risks, you're fine, and property's great. But I worry that a lot of people don't, right?
Yeah.
But then in terms of that competitive market, well, they are very different things. And of course, we talk about owning the world means all assets in all geographical regions. And the thing about the market, I'll go back to what I said earlier, is, very few people know. If you say, what does the stock market return? Well, the US stock market, the S&P 500, and before 1956 or 1957, it was the S&P, there weren't 500 companies back then. But the S&P, going back to 1872, between January 1872 to be clear, not 1972, and December of last year, the annualized performance of the S&P was 9.23%, right? And, that's through lots of periods of inflation being very low and periods of inflation being very high, but that's the top headline number, right? And like, if you think about 9% return is a pretty interesting return, right? But most investors only make 5%. Most people who knowingly invest in the stock market, because they sell at lows and buy at highs because of the fear and greed dynamic, and they don't take themselves out of the equation. They worry about the Gulf War or Libyan refugees or whatever, and it forces them to. But if you want to get near to that 9% return, which is a great return, then you need only buy every month for a long period of time. Now, that doesn't really help you in terms of cash flow, but it does help you in terms of wealth generation. And now you only need to do that with a relatively small percentage of your assets, right? So yeah, it's different. It's different to property, and it's a different pot. But if you don't have that pot, then you're likely to suffer from what many commentators call underperformance risk. If you're not getting into the juicy returns you can get from equities, the long run returns. And you have to wear volatility. So, stock markets do crash by 50% or so every 10 years or so. But that, if you're buying every month, that doesn't matter, because last month you bought 1,500 and now you're buying at 666, and then 710, and then 900. I'm talking about the S&P in 07, 08, 09. So it's very important that you have your system. You know what you're doing. You're long run and you're buying every month to smooth those returns. But yeah, the market is very different to property. But the one other thing to say about that is, so one of the ideas we talk about is called 100 minus your age, which is a very simple and elegant way of legislating for that market crash problem. Because if you're 30 and you've got 10 grand and the market crashes, you've got 10 grand in the market, now you've got 5 grand. That's annoying and it's a little bit of a setback. But if you're 60 and you've got £1 million in the market because you've had a great career and you've got a big pension and it's in the market and there's a 50% crash, you've got £500,000. You've just lost £500,000. Those are two very different problems. And the way to get around, as you get older, you need to be thinking more about the return of your money, not the return on your money. And the simplest and most elegant rule of thumb to deal with that we talk about is 100 minus your age, which is simply that you subtract your age from 100, and that tells you what percentage of your assets should be in defensive assets. So, basically, if you're 60, 60% of your assets should be in defensive assets and 40 should be in aggressive assets. And if you're 30, 70% can be in aggressive, and aggressive is the market, the stock market, and 30% should be in cash or some kind of defensive asset, which is very hard with interest rates at 2%, because that means it's kind of an underperforming bit of your. But I've written about this a lot. But yeah, so the market won't give you. I mean, you can get dividends from the market, and at certain points in the market cycle, the FTSE is famously high yielding. The total return of the FTSE is, I think the dividend yield on the FTSE is about 4% at the moment. So that plus whatever you say in terms of top line performance is probably quite interesting. But I think that with all of this, the simple thing is to just make sure you look at everything holistically and you have the right allocation to the right pots and the right time frame.
Yeah. And without us kind of going too far down this route, but would some potential cash flow strategies be trading or options? Yeah,
and that's fine. But we spend a lot of time talking about the difference between trading and investing, as I said at the beginning of the call, because investing is for absolutely everyone, and it's a complete tragedy that far too few people in Britain know anything about or think about investing. It's a tragedy for those individuals, and it's a tragedy for British society, because the more people invest, the fewer dependents there are on government. The more likely people are to become wealthy, the more capital there is for companies doing innovative things, and it's a tragedy we're really bad at that. Options, strategies, all that sort of stuff's fine, but I think you need to be sophisticated. You need to really understand that there's a lot of work involved. I always say this: anybody tells you can learn to trade in 5 minutes a day they can trade in 5 minutes a day because they've been doing it for 20 years. But I always say it's at least an A level, probably a degree's worth of knowledge to get good enough to protect the downside and actually make enough return in absolute terms. And that's the other point about trading is, the biggest rookie mistake, which we've seen so much in the crypto market in recent years, is somebody with $2 grand going, oh yeah, I'm going to get into crypto and I'll make 100% a year. I'm making 20% a week. I mean, it boils my blood, to be honest, because there's so many disingenuous people suggesting that's possible and that's going to be real. There's somebody who was posting the other day that they're making 20% a week every week. And I avoid it now because I try and stay on message. But I felt like saying, you do realize that mathematically, if you make 20% a week every week, within a few years, you will have all the money in the world. Is that what you're suggesting that you're going to achieve? Because you're not going to achieve it, because none of these people ever talk about the week they were down 10% or down 20%. And it makes me very angry that people are allowed to say that without being regulated. Because if you talk about crypto or FX trading, you don't need to be regulated by the FCA, and you can say whatever you want. If I say anything, I'm regulated by the FCA. Everything's recorded for 6 years. I have to be fair, clear, and not misleading, etc., etc. And that is a real problem, which has caused untold misery, bankruptcies, divorces, dare I even say suicide, right? And that is a big failure of the system. But look, trading is fine. Trading strategies are fine. Just I think you need if you have 100 grand and you're aspiring to make a couple of % a month and you're willing to commit some time to it, that's great, because in absolute terms, you maybe make 2 or 3 grand a month from a big pot of capital. If you have 2 grand and you need to make 100% a month, it's a total waste of your time, and you should spend that time getting better at your job and investing, not on trading. And I feel very passionate about that, as you can probably tell, because it is a tragedy that so many kids are watching TikTok and having really disingenuous people suggest to them that cryptos will do this, and because they use unqualified language. They say we'll do this. We're all going to be millionaires, and it's like in '99 in the dot-com boom, the internet was going to change the world, but 90% plus of the companies involved went to zero, and the crypto will be exactly the same. There will be massive crypto winners, which are the Apples and Microsofts and Googles of crypto, but nobody knows what they are yet, and 90+% of them are going to go to zero. If the lesson of 99, 2000 and .com is anything to go by.
Yeah. So much that we could continue to talk with there, but I really want to kind of switch gears a little bit, although it's not really switching a gear, but certainly looking now to what you've been focusing on more recently. And of course, Own the World, then How to Own the World. That's over 10 years ago, right? When the first book came out. So it's about time, right, for a second book. And I know you've written other books as well, but your next book, Our Future is Biotech. Tell us a bit more about this.
Yeah, so I was really, really honoured I got a partnership at a boutique investment bank at the end of 2014, where I got to specialise in biotech life sciences companies. So, medical devices, companies trying to cure cancer, surgical robotics, companies with blood tests to diagnose cancer instead of horrible invasive surgeries on general anaesthetic. I mean, just world-changing, inspiring stuff. And I met so many companies in the 8. I've now been focused on that stuff for 8 years. And I've just met companies where you almost get goosebumps when you meet them. It's so thrilling and it's so exciting. And because of that, I've spent a lot of time just looking big picture at all the new biotech. Jennifer Doudna won the Nobel Prize in 2020 for a technology called CRISPR, which is a gene editing technology, which is, anybody who wants to spend a bit of time reading the book. Walter Isaacson, who's a very famous biographer, published a biography of her, what's it called? The Code Breakers, I think it's called. It's on the floor over there. But anyway, so super excited about the sector. And when I decided to quit, I decided to resign from that job just over a year ago to work full-time on plain English finance on everything I'm doing. And part of what motivated that decision, which is pretty significant personal financial risk for me, like giving up a job and going to do my own thing. But I did get a book deal with our publisher, with the publisher of How to Own the World, for a new book called Our Future is Biotech. So I'd written a plan. This is what's going to be in it, and how about that? And I don't know if many of the audience will be aware of Yuval Harari, who wrote a book called Sapiens and a book called Homo Deus. It was so he sold something like 30 million copies of those books. He's like the biggest non-fiction author publishing success of the last decade or so. So slightly cynically suggested to my publisher, they were like, who's the target market for this book, Our Future is Biotech? I said, well, anybody who's bought Yuval Harari's books. So they gave me a book deal. Let's, fingers crossed, we sell a few. I don't obviously, if we sell 30 million, I'll be very happy, but well, we'll see how we go. See if your readers give us some pre-orders in the fullness of time, or your audience. Sorry. But no, but it's really exciting. I literally went through 115,000 words on that book like the other day, and I'm inching towards delivering the manuscript to the publisher, and we're going to hopefully publish it next year. But the basic insight is that, you know how I said earlier, human progress is the biggest investment theme, right? Human progress is what has driven those 9% returns of US equities. So, and that's been supercharged by the internet, by smartphones, you know, that sort of, if you like, the last century has been about physics, about you know, transistors and aviation and automotive, and the next century is going to be about biotech for a very simple big picture reason, which is that you create value economically by solving human challenges. So you want to fly, well, you create a lot of value by creating an airplane, right? You know, you want to move vast amounts of wheat and beef and oil around the world, you create value by creating the super tanker industry and, you know, 20-ton tankers and the automotive industry and everything else. And most of the problems we still confront as a species are problems of biological systems. So most obviously in therapeutics, that's like, there are a lot of people who die of cancer, you know, that early onset dementia, Parkinson's disease, diabetes, obesity, loads of psychological disease, you know, autism, all that. We have a whole bunch of modern plagues now that we're all living longer. And so companies that can solve those problems will create enormous economic value. And those problems are obviously, they're not problems you can, well, there's convergence, because obviously processing power is really important for this sort of research. So it's the convergence of tech and biotech, but it's the exponentially developing science, Nobel Prize winning science that's going to, you know, gives us a real shot of curing cancer and rolling back all sorts of other real problems in the next few years. But biotech is also going to be crucial for a lot of things that aren't to do with curing disease. So rolling back environmental degradation, clean power generation, processing power, biological computers that use DNA instead of zeros and ones. You know, that's a real thing. It's science fact is increasingly looking like science fiction. You know, Arthur C. Clarke, the guy who wrote 2001: A Space Odyssey, famously said that any sufficiently advanced technology is indistinguishable from magic. And I've seen a lot of magic in the last few years. That, you know, there's some really amazing stuff coming down the pipe. It doesn't get much coverage because it's kind of, you only read about it in like New Scientist or whatever. I think a lot of these technologies are going to go quite mainstream in the next few years. So yeah, I'm writing a book about it, and I was really fortunate this week. The Financial Times very kindly wrote an article about another plan we have, which is we're looking to float a company on the London stock market called the Conviction Life Sciences Company, which basically is going to invest in a bunch of companies that are, you know, delivering everything that I'm talking about. And I can't say any more than that, because until we publish the prospectus for that, which is going to be imminently, I can't talk about it or explain what it is in any more detail. But you know, basically, yeah, it's finishing Our Future is Biotech, my next book. It's just this belief that it's the next leg of human progress is going to come from biotech. And let's hope, you know, because as I say at the beginning of the book, there's an article on my website. If you go to the opinion page of plainenglishfinance.com, the most recent piece is called Our Future is Biotech, and it's got the first chapter from the new book. And, you know, one of the points I make is it's not just about economic value creation or curing cancer. It's actually just a really positive and empowering way of looking at the world. It's the, you know, if these and the likelihood that we have a Star Trek future instead of a Mad Max future, right? Because if we can cure disease, sort out obesity and autism and diabetes, and, you know, in terms of rolling back environmental degradation, the things that biotech companies will be able to do to agricultural productivity in the next couple of decades could mean that we could rewild more than 90% of the land that's currently used for livestock farming. It's very Star Trek, right? But that almost in one swoop gets rid of like a third of our greenhouse gas emission problem. Yeah. You know, and these technologies can, and so everybody's sitting here, you know, Greta Thunberg, and everyone's, the world is screwed, and, you know, should I have children because everything, you know, we've never been more pessimistic as a species. Like when 6% of Americans think the world's getting better, only 6%, and like 4% of Western Europeans, or some horrible statistic like that. When in actual fact, there's real hope that these technologies will make all of our lives longer, safer, healthier, better. You know, we could all be running marathons at 80. You know, and I know that sounds crazy, but it's no crazier than one of the examples I use in the book is in the 1850s, when the railways first started going out and about in Victorian England. There were articles written in the press about railway madness, and they basically said that if the human body went more than 20 miles an hour, it could result in madness or death. Okay, and all these Victorian ladies were going, "Oh, I can't possibly go on a train." You know, sorry, I probably shouldn't do vignettes of Victorian ladies, but anyway, it was a very real concern. If you'd said to a Victorian, you know, this is only 5 generations ago, whatever it is. By the way, if you go to China in the year 2020 and Japan, there will be millions of people traveling at 200 miles an hour every single day of the week, all over both of those countries, China and Japan. You know, so if you'd said that to somebody in 1900, they'd thought you were completely insane. If you'd said to somebody in 1900 that 50 years later we'd have spaceships, be putting people into orbit, and you know, people would be routinely flying around the world in airplanes, they would have thought you were completely mad. And I genuinely think biotech is on the cusp of delivering a lot of really magnificent progress, which will make all of our lives so much better, and might solve the pensions crisis. Because if it creates, if we cure cancer, we deliver like robotics for elderly care. You know, we deliver massively improved agricultural productivity in places like India and Indonesia and Latin America. It's going to just, and architecture, you know, better buildings that power themselves from solar. And there's so much to be positive about, but so little of it makes it into the public consciousness. And that's what my little mission is at the moment, is to put it all in a book and then to try and, do something about it in terms of a fund as well.
Yeah.
God, sorry, that was a really, so go on.
No, I was going to say, so definitely, head over to plainenglishfinance.com, because there's so many great resources there. You've got a community, obviously, where you're in there helping your members as well, Andrew. So that's a great place. Download that chapter. And when's the expected release date for that book?
So I sent a manuscript to the publisher this Monday morning and said, can you read this now? There are 2 or 3 little sections left for me to finish, because now I'm focusing on this IPO we're doing on the London stock market for the next month. December and January is when I'm going to get back to top and tailing it, but I don't know, because it can take 3 to 6 months for the publisher to do the full edit and the artwork and everything else. So, I hope towards the end of the first half of next year.
Yeah. So that'll be 2023. And it's nice to end with some hope there, because as you say, the doom and gloom that the press and the media paint, and at the moment, of course, we're just in the thick of it. And, it does affect people, Andrew. So I think just to, round things off for our conversation today is just to emphasize that you just stick to your plan. Don't listen to what others are saying. And for those that are worried about the next 2 or 3 years ahead, Andrew, in terms of building their wealth, what are just any additional final words?
Well, I mean, the psychological and emotional side of it's really important. Like, it pays to be bullish. There's a great quote from a guy called Thomas Babington Macaulay, which is by what element is it that we see nothing but progress behind us and expect nothing but deterioration in front of us, right? And it's the human condition. Humans have been getting better, wealthier, longer lived, politically freer, sexually freer. We've been getting nicer and better, and ignoring all the nonsense on Twitter and Facebook. But broadly, 100 years ago, or certainly 500 years ago, the risk that you die in mortal combat as a man was extremely high, and obviously only 100 and a bit years ago, with First World War, Second World War, Vietnam War, Korea, Ukraine is dreadful, Yemen is dreadful, but the world is in aggregate a much, much better, safer, wonderful place compared to the past. And how do you monetize that? Well, if you believe in that, if you believe in human progress, then, it's actually very simple. You just make sure you own some equities. Because the companies that are delivering this growth in every sector of the world, the easiest thing to do is just just have exposure, whether that's to the S&P 500, which is the 500 American companies, which obviously, they earn a lot of their money outside of America, obviously, Apple or Microsoft or whatever. But there's also a thing called the MSCI World, which is 1,600 companies, the biggest companies in the world from America and Europe and Asia. So that's, if you think that the last 50 years of American exceptionalism, maybe America's doing this. Ray Dalio, the biggest hedge fund manager in the world, wrote a book called The Changing World Order, which I'm sure many of your audience are aware of already, which basically said, Holland was the biggest power in the world, then Britain, then America, and now it's China. And so everyone should despair. And I don't know, will that happen? I think there's a linear progression as well as a circular progression in history. When America took over from Britain, there was no such thing as an iPhone. So, the world, my point is that the world changes. You can learn things from history, but the basis is always different because the world today is so different to the last time it happened. So who knows? But anyway, sorry, that's it again. I've had too much coffee obviously this morning, but basically just make sure that you are well balanced in your finances across all assets and with a weather eye on all geographies. And then, if you do that and you stick to your guns and you do it over several decades, you've got a really good chance of being wealthy. And sadly, that message it's not taught in schools, and it's you certainly, by the way, you don't even learn it if you do an economics degree. I can tell you from firsthand experience. So, but you will learn it from my book, obviously.
Yeah.
He said.
Yeah.
But we're big believers. I'm a huge believer in everything I'm saying, and I if even in a small way we can help be a part of driving those innovative businesses, that's kind of why we're doing what we're doing. So sorry, yeah. I'll shut up now.
No, we can see your passion coming through, Andrew, and really appreciate all the fantastic work that you're doing to make your dent in the world. So thank you so much for sharing everything with us today. Definitely look forward to catching up with you again in the future, and good luck with all of your projects and with the forthcoming book.
Thank you very much, Christian.
Wow. Okay. So much there. Great stuff from Andrew, and we'll dive in as we always do, pull out a few of those lessons. I think just before we went into the interview, I talked about our webinar coming up on the 23rd, Kevin, just to let people know where to go to register. So head to WealthBuilders.
I thought you were slipping a bit, Chris. I don't quite know where that came from.
Yeah, head to wealthbuilders.co.uk/academy webinar and join Kevin and myself on the 23rd. And all right, let's quickly go to Trustpilot because we don't want to miss out on the reviews we've had this week. And let me scroll through. We've had quite a few, but I'm going to pull out. Let me have a look here. Oh, going back too far. I saw one in particular that's come in. Oh, here we go, from Andrew, who says, great support and guidance. I've been listening to the podcast now for 12 months. In February this year, I decided to take control of my own financial destiny. I already had some of the pieces of the jigsaw, and WealthBuilders added more pieces, but more importantly, are showing me how to put them together. Everyone I've come across has acted with integrity and honesty, and the community is very supportive. Kevin has taken the time to directly help me with my pension charges. And having spent time putting the foundations in place, I'm looking forward to accelerating my wealth over the next few years.
There you go. I mean, it's interesting, isn't it? I love the language you chose there. Jigsaw puzzle pieces, then discovering more pieces, and then how to put them together to see the whole lid of the jigsaw, which is really your wealth target. What do you need to have to be completely financially independent? What does that lifestyle look like? That's the jigsaw puzzle. The pieces will fall together once you commit to a plan. And I think it's great. I was talking to somebody today who said they'd been following the podcast for about a year or so, but then just decided to connect because they'd been hearing so many good things. And I think that's also good, Chris. So you listeners out there, one day you may connect with us, and we'd be thrilled and delighted if you do. But just keep thinking about the little lessons you can learn. And I'd like to take a leaf out of Mr. Craig's book, who made the point, Chris, didn't he, that one of the ways to build wealth, not the only way, and it's certainly a slower way, is to build wealth by buying into the market, all sectors, all geographies, every month. Well, that's no different in many respects to one of the key lessons we talk about in wealth building, which is make a good decision that moves your wealth forward every month. We articulate that slightly differently. Never let 30 days go by without doing something to help build your wealth. And it's the same thing. But instead of that thing being a pound or £50 or £100 or £200 or whatever, taking advantage of pound cost averaging or dollar cost averaging wherever you are in the world, we're talking about taking more direct ownership of things. So in addition to what Andrew's saying, is build the wealth in addition to that. So I think we're very much complementing each other in a very, very positive way. So I liked his message and thought he gave that a good airing.
Yeah, absolutely. And, focusing on pillar 2 in our 7-pillar framework. Pillar 2 is...
pensions, Chris.
Pillar 3 is about pensions.
It's a bit above pillar 2 and pillar 3, Chris.
Yeah.
How long have you been doing this, mate? Do you need a break?
It's been a long day. It's been a long day.
You need a sabbatical, Chris.
I did mean pillar 3 for investments, but we talked about both, didn't we? We talked about the black cloud that's looming for pensions. Well, obviously pensions very close to our hearts, in particular yours, Kevin. What are your views?
What about the pension storm? Well, I think he's absolutely right that the amount of taxpayers coming through to pay the tax for the retirees in the future, there's a problem, right? The maths doesn't stack up. So consequently, there's going to be issues there. We know that's coming. So the state pension age got to go back. The value of the state pension will probably be clipped. And we already know that there's some concerns about, what they do with pensions as a easy source of access. And they've done that with property, haven't they? The government, they've done that in so many different ways. So they're going to nick some tax back somewhere down the line. Is it going to have to be one of the pillars? Is it your home? Is it your pension? Is it your investments? Is it your portfolio of property? Well, property people have seen that before. Is there some weird and wonderful tax on IP? So Andrew Craig is going to have to pay taxes for a loyalty levy or a royalty levy, should I say? I don't know. But the best thing to do is build your wealth in a rich and a diversified way. And we love to have guests that give a complementing view or even a completely different view to help you form the view that you should take to help you put your jigsaw puzzle pieces together in the best way that you can.
Yeah. And just towards the end, we talked about the next book that Andrew's just finishing off, Our Future is Biotech, and, really exciting. Looking forward to reading that one about the life-changing technologies afoot now. And, we talk about ROIs. That very much ties in kind of return on impact, doesn't it? The big changes that you can make and real purpose.
Yeah, I think he made a very interesting point. That's the howling dog. We get that from time to time when it's real, don't we, Chris? I knew there was going to be a howling dog somewhere in our podcast episodes. And that's Alan, by the way, who's my black Labrador. Met a lady today who said her dog was called Eddie. I thought how brilliant it would be for Eddie and Alan to go for a little walk together.
Yeah, just need to find Charles and then we'll have the trio. Yes.
Anyway, I was losing my train of thought there. But the point he was making is that the stock market, rises and falls and markets change. But the big redeemer, the big factor that makes the difference is changes in technology, changes in human endeavor that somehow make a breakthrough and change the value of the stock market and make more profits. Because in the end, the stock market is investing in businesses that are trying to make profit, and you take a small stake in those. So you've got to pay attention, don't you, to where the future profits are coming. And some of you look at any economy, you go back, you talked about things from 1892 and the long-term yield. I'm not sure I'd go back that far because the world is a completely different place. And you can't build your life on a spectrum of over 100 years. You can only build it over your own spectrum. And I think while the stock market can be a place, if you invest for the long term, I'm just not certain that you can control enough for it to be a great place to build wealth for you in a 5 to 7 year period. So great to be definitely adding. Great to be, if you're young, if you've got children, younger people, you definitely want to be encouraging them to do that. But if you're joining in your 40s and your 50s and your 60s, stock market probably won't give you the pathway to becoming financially independent. but definitely would be a place to be part of your 7 pillars.
Yeah. And I would encourage anyone listening who hasn't checked out Andrew's book, go and get yourself a copy of How to Own the World. It really is fantastic. And, if you're listening and you're thinking, I don't know which pillar's right for me, then don't forget, join Kevin and myself on Wednesday, the 23rd. We're doing a live webinar, starts at 7:30 p.m. in the evening, and we're going to go through our recurring revenue roadmap. We'll look at all 7 of those pillars, help you understand those in a bit more detail, and then show you how we can potentially help you inside the Wealth Builders Academy. So we'll look forward to seeing you there. And Kevin, you and I will be back same time, same place next week.
Yeah, I hope we perform a bit better next time, Chris. It seems like we're being very amateurish today, but mostly you, I have to say.
All right. On that note, time to sign out.
Until then, my friend. See ya.